Hey there, this is Casey with Strategic Mortgage Solutions here for the Tuesday Mortgage Talk. I don't have a lot to talk about. I want to be quick and brief, but I have a couple cool points I wanted to share with you that I think will be valuable. Number one is the Federal Housing Finance Authority has actually announced here last week that they were going to allow the raising of conventional loan limits for Fannie Mae and Freddie Mac. Now the new loan limit will be 510,000. That's about 5.38% higher than what the current 2019 loan limits are. That also raises the high balance conventional loan limits. So we do have a nationwide high balance conventional loan product to avoid people from having to do jumbo, minimum 10% down, no mortgage insurance. So if you have somebody looking to finance more than 510,000, give us a call. Give us a call anyway, just so that we can give you a quote on what kind of rates and fees you can get through an independent broker like us. Now, this is on the backs of just VA announcing that they also did away with their maximum loan limits for their no money down products. Before it was tied to the standard conventional limits, where anything over and above that, the borrower had to show a 25% equity position with consideration to every $1,000 that they were over and above that loan limit. So if you were, $100,000 over the conventional loan limit on a VA loan, you'd have to have a 25% equity stake, for that 100,000 that you were over. Again, that's been done away with, so that's good news. Here shortly, we're expecting that HUD's going to announce that FHA is also going to raise their loan limits. It's probably going to be very similar to the loan limit raise that conventional loans just went under, where you might see the loan limits raised by around 5%. That might make the new FHA loan limits somewhere around like 335,000. As soon as we hear the announcement, I'll share that in the next Tuesday mortgage update. Something else I want to share with you is a recent underwriting nuance that we came across with a particular lender. This was in relation to somebody we're trying to help get qualified for a refinance, and they are commissioned employee. They actually had started at the company they worked for about 8-9 months ago, so they didn't have an extensive history of working at one particular employer to document commission income, but they did have well over a 2-year history of working in the same type of industry, making commissions. And normally, when we're helping somebody get qualified for a loan, we usually initially look at what the 2-year average compares to the 1-year average, and then we look to see what they've been averaging over with in the last 6 months, 9 months, however long it has been at the new employer that they've worked for. And oftentimes we'll side with going with the more conservative monthly income from that commission as the worst case scenario for qualifying somebody. And then if we need more income, we'll double check with the lender and the underwriting team to see if there's a way to squeeze more juice out of that income equation, so to speak. Well, in this case, what I thought was really interesting was that when I reached out to the underwriters to see about squeezing a little bit more income, they came back to me with a surprising nuance about how they take the conventional underwriting guidelines with regards to commission and bonus type income. You see, their take on it is that they will go off of the average for the period of time that the employee's been at the new job, so long as they've got at least 2-year history of working in that industry and making commissions. That's really interesting because this particular person had taken a job that in a lot of ways was a step up, an opportunity where they could make more, where in fact, not only was she promised she'd make more money, but she actually did, and actually has averaged about, I wouldn't say quite double what she'd previously averaged, but it was something to that effect. And if you compared it to the 9 months of income history that we had, it was double versus what it could have been as a 2-year average. And that allowed us to be able to make it a bit easier for us to qualify this borrower for the type of loan that she wanted to get. And so I guess, keep that in mind. As an independent broker, a lot of clients and referral partners, realtors, they tend to think of us as being a place to go to where clients can get great rates, great fees, and oftentimes better than what they would get with a direct lending channel or bank. However, one of the other features, or I would say benefits to working with us, is that sometimes when you have a borrower with a unique situation, or in this case, somebody that's commissioned that has been a more recently employed person at a new place, but has that 2-year history, we were able to get this person qualified for a loan that they might not otherwise have gotten through another lender that has a different sort of take on the conventional loan guidelines on commission income. So if you're somebody that works in a commission type environment, whether you're a loan officer or somebody that sells cars, F&I person, anybody that has commission type income, you might want to reach out to an independent mortgage broker as one of the places you check first to see about whether you qualify for home financing, because you might find that you're going to get more yeses from that channel because their ability to shop around not just for best rates and fees, but also the best take on conventional guidelines with regards to bonus, commission type income. That's Casey with Strategic Mortgage Solutions. Have a great day.